I'm going to do a reasonability check of two different share prices, Amazon and Tesla. And it's not necessarily going to be a valuation as such, but what I'll look at is the current prices as of March 31st, 2020 for both the companies, and also the earnings per share that they've earned over the last 12 months. And keep in mind that this is after a pretty significant market decline. In March, the markets fell over 30% as a result of the COVID crisis. So these share prices that I've got reflect that decrease. Okay, now it's not going to be a valuation like I did in the other videos. I'm just going to present some facts about the value and what it relates to the current operations and future growth, and you can come to your own conclusions on it. Okay, so first of all, what is the share price? The share price, that's actually what the stock has traded at. So somebody's paid that price and somebody sold it for that price. So two people deemed that to be an accurate valuation of the company. And if you want to break it down, it's going to be based on the value of the company's existing operations, so the earnings that they're making right now, plus the value of any future growth on top of that. And that's true for every company out there. Now, these both are growth-oriented companies, so we're going to look at how much of the share price is broken down of each. The existing operations are known. The future is an estimate. Okay. So what are the existing operations? If we're going to do this on a per share basis, because it's the easiest thing. So you take the earnings per share, that's what they're earning right now, and you divide it by the expected return that the investor wants to earn on that company. And that's the discount rate, plus the present value of all of the future growth opportunities that the company is going to make. So if you add those two together, that will give you the share price of the company, and you can get that information. At least the earnings per share and the expected earnings per share is readily available. The share price is available. Expected return you would have to estimate. So let's look at Amazon. The share price is $1,949 per share, despite the decline. And the earnings per share for the last 12 months as of March were $20.93 per share. And I'm going to assume 12% as the expected return. The average market return is somewhere in the neighborhood of about 8%. And I'm going to say Amazon's maybe a little bit riskier than that because it's a tech company. And so investors who want to earn some return in there are going to expect a higher return than average to invest in Amazon because they're taking a higher risk. Okay? So we'll divide that by 0.12. And that's just my guess. You could use whatever number you feel is appropriate. And then that gives you the value of the current operations, plus you take the present value of the growth opportunities. And that essentially is going to be the plug that we calculate. So we know the share price, and then if we take $20.93 divided by 0.12, that becomes $174. And then the plug to make the equation balance is going to be the $17.75. So this is the present value of all of the future growth. So if you were to break down the share price of $1,949, and that's the 100% of the share price, 9% of that comes from the existing operations, and 91% of it comes from projected growth. So remember we said that the existing operations are known and the growth is an estimate. It tells you how much variability you could expect. So if your estimate is wrong, it would swing a great deal. In either direction. If you underestimated it and it grew faster, that number would go higher, and vice versa. And not surprisingly, but for most tech companies, high growth companies, the vast majority of the value is from growth. The existing operations are not as significant. Unlike a company like maybe Walmart or a bank or something like that, where existing operations would contribute the majority of the value. Tesla is another story. Tesla actually has a negative earnings per share right now. Okay? And it is kind of getting close to becoming positive, but if it's negative on the last 12-month basis, essentially there is no value for current operations, or there's actually a negative value if you want to be particular about it. I'm just going to say the current operations are worth 0. So then the full share price of this company is based on future growth and the value associated with that future growth. and investors are willing to pay the current share price based on expected earnings that will be generated from the variety of industries that they work in, primarily in the electric cars and whatnot. So are these companies overvalued or not? That's a personal decision. I mean, so basically, we can conclude that almost all of the value for these companies is based on their growth. So then if they are overvalued, it depends on what your expectation of growth is. If you think that they will not live up to the growth that is expected or by people, then they are overvalued. If you think they will live up to that growth or exceed it, then you could argue that they're undervalued at that stage.